Hey, good morning, everyone. Welcome. It is September 21st, Thursday. Hope everyone is doing well. The day after Jerome Powell just killed the market, right? The FOMC was yesterday, and a lot has happened since, right? Markets down about 100 points from the peak of yesterday into the bottoms of the overnight session. Overnight alone, we're down about 50 handles, 40 handles, let's call it, whatever. Still substantial downside movement on today's session, on today's overnight session. And a lot of this can be attributed to what had happened with the Federal Reserve, right? Markets are still taking in the information, the messaging from the Federal Reserve, which wrapped up the two-day policy meeting on Wednesday afternoon. And the fact that we've come this far led us to really proceed carefully. This is what Jerome Powell said, right? Chair of the Federal Reserve, emphasizing some recent battles, one on the inflation front, but citing risks related to the overly resilient economy and labor market. On that note, central bank kept the rates unchanged at between 5.25% and 5.5% for the second time this year, though investors were watching what might come in terms of the FOMC's economic projections, monetary policy projections, and the dot plot. So the dots, right? Excuse me. Dot plot is a very important figure in the Federal Reserve's meeting because it allows us to see what the expectations for future rates look like, right? Towards the end of this year, 2024, right? So on and so forth. So the median projection for the federal funds rate at the end of the year was 5.6%, implying one more hike. The same seen in the June projection, and policymakers increased their forecast for the Fed's funds rate at the end of 2024 to 5.1% compared to the previous 4.6%. While median projections for the end of 2025 rose to 3.9% from 3.4%, and fewer rate cuts were seen in 2024, leading benchmark indices to close the session a lot lower. Right, Nasdaq dropped 1.5%, 1.5%, massive downside. Nasdaq futures now below 15,000. The yield on the two-year Treasury note, which reflects interest rate expectations, hit 5.118%, marking the highest level since 2006, which is another concern that a lot of people are mulling over, that yields are aggressively high and the bond market's getting crushed, right? So forecasts are highly uncertain, and forecasting is very difficult. Forecasters are a humble lot with much to be humble about. This is what Powell noted during his press conference. In terms of inflation, you are seeing the last three readings are very good readings. It's only three readings. We were well aware that we need to see more than three readings, and the only concern it just means this. Wow. Okay, so that's a quote from Jerome Powell. I had difficulty reading them. If the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. So, so far, this Fed has seemed to add enough pressure on financial conditions with less fallout for growth and employment compared to the U.S. Inflation battles. And that has led to the market price in an economic soft landing, pretty much, which has helped prop stocks up for much of the year. And contrary to many of the initial forecasts on Wall Street, we're seeing somewhat of a sustained growth path. Excuse me. The key question is whether that can keep on going. So have the 525 basis points in the interest rate hikes delivered since March 2022 already filtered through the economy? Will things hold up, right? Will things hold up throughout 2024? Will these high energy level prices hold up, which I think oil is at a local top, which is going to turn and pull back? I think that generally speaking, a lot of people are very fearful right now, looking at this pullback in the market as the start of a very strong recessionary move. Excuse me. So sorry. As a pullback for a very strong recessionary move. But realistically, what's going on, right? These aspects and these data points are delayed in terms of economic market movement, right? And the effects they have on the economy. Realistically, what we can expect is to see some kind of general upside towards the end of the year and into the latter half of 2024. That's when those lagging events are expected to hit. And we have a lot of uncertainty right now. Yields extremely high, labor market pretty tight, right? Rates higher for longer, realistically. So it's going to be very interesting to see how this does play out. But realistically, I think a lot of people are going panic mode and comparing too many charts that look like the 2008 chart to what we have right now and thinking, oh, okay, we're going to dump. Jeez, excuse me. We're going to dump another 30% here. Realistically, all that goes down probably in 2024 towards the end, or 2025 realistically. So those are things that I'm looking at. The Fed has put a lot of downside pressure in this market. I think that we do have more room to go to the downside based also on seasonality and general market cycles. We do have some expectation to see some of this downside move. And an important thing is that markets generally bottom before the earnings period bottoms. So if we have seen a bottom in January this year, or whatever the case may be, we should expect the next few quarters of earnings to reflect that and start running. So that's going to be an important factor to look at, which again is a lagging indication in the next few quarters to see how the earnings shape up. So before anyone starts screaming recession, 2008 like crash, we have to see more data points, which are going to be lagging. So there is a lot of time until that. Now, when it comes down to the market, the S&P 500 futures, we've dropped significantly, obviously, right? We've broken through a lot of these levels. And we've dumped through that 40. Sorry, what is this level I'm looking at here? We have dumped through the 44.50. Geez, give me a minute. We've dumped through that 44.50, 58, 44.60 region, which is also the start of a distribution lower, right? What that suggests is that we're accepting into said distribution lower and targeting areas to the downside, and the lower band of the distribution happens to be 44.03 to 05. So right now we're up about 6, 7, or 7, 8 handles from that 44.05 area, 03 area. And we're looking to see if we can bounce a little harder today towards the open before any real sellers come in again. We've now explored the bottom end of that distribution. There's also a larger area towards the lows, right? 43.80, 43.70, 43.60 in that block. So I think that we do have to run some stops and profit taking before we explore some more of that downside realistically. So let's keep that into consideration as we go forth. And let's open up our live trading room. Yesterday we traded the FOMC. There was some opportunities, right? We caught a bit of that upside that happened earlier on. And I'll see you guys tomorrow. Let's wrap that up. And don't forget, check out our website. We got a free futures course that'll help you understand distributions and help you understand why we were so bearish overnight in this market. So I'll see you guys later, and we'll chat tomorrow. Thank you and take care. Happy trading.